I bid you all good morning, good evening, and good night, wherever you may be watching this transmission. Tis I, Mike Martins. Thank you so much for joining me. Mortgages now in Canada, I've been watching them, been following them in Australia, New Zealand, all over the Commonwealth. And right now in Canada, mortgages now have hit the point of no return. And a point of no return as deferrals have hit a record. And deferrals are basically, deferrals is making an agreement with your institution or lender to put your mortgage or your payments on hold. But when you're deferring payments, your debt load is growing. It's getting bigger. And there's fees, and there's all kinds happening. And right now, we are seeing a mortgage debt explosion and growth. And deferrals are hitting huge numbers. So we got an article here that we're going to switch over to article scan from Better Dwelling. And you guys are going to take a look at this. And it's at the point of no return now. We've been discussing this for the last decade on the channel. Affordability levels. Not a lot of channels were addressing this 10 years ago. And affordability levels were going right out the window. Cities be turned into empty shells across the Commonwealth. Name a major city in the Commonwealth and tell me if it's affordable or not. Go ahead. Dublin, nope. Edinburgh, no. Auckland, no. Sydney, no. Hobart, no. Vancouver, no. Toronto, no. Whole west coast of America, gone. Affordability levels are not there. Wages haven't kept up, and now we're in a conundrum of a massive point right now in mortgage history. And I've been reporting on mortgages and affordability levels and foreign buyer's tax and vacant home taxes all over, from California all the way down all the way to Christchurch, New Zealand. And this is big. This is the biggest one. This is the one right now. These numbers don't lie. So let's head over there right now real quick. Let's head over to article scan. Here it is, guys. Let me open this up a little bit more so you could read along with me. So here it is, guys. Canadian mortgage debt explodes in growth as payment deferrals hit over 743,000. That's almost a million. And wait till you see how much people owe in mortgage debt in Canada, with a population of 33 million, maybe, if we're lucky. Canadian mortgage debt is growing at a rapid pace, but it's not exactly a healthy trend, says. This is from Bank of Canada. And now Bank of Canada is coming forward now. Before, Bank of Canada would lay things out like everything was okay, everything's good, nothing to see here, nobody panic. Bank of Canada shows mortgage credit hit a new record high in May. The high was hit with accelerated growth, but this isn't the bullish trend it normally is. Hundreds of thousands of mortgages had their payments deferred, helping debt grow. So basically the debt's growing, obviously, because they're going to tack on the extra months, the extra fees, right, for deferring the payment, of course. And that's going to add a couple of extra fees, extra few dollars here and there. Canadians owe $1.68 trillion in mortgage debt. Wow. Canadian mortgage credit pushed to another all-time high at a rapid pace of growth. The outstanding balance of mortgage debt reached $1.68 trillion in May, up 0.6% from the month before. This represents an increase of 6% compared to the same month last year. All of those numbers are very large. But with lowered sales volume, what gives? So you're getting more mortgage debt, okay? But you're getting lower sales volumes. That's not normal. That's not normal at all. So here's the Canadian outstanding mortgage debt, the outstanding balance of Canadian mortgage credit. So here it is, guys. Here we go. These are the recession bars. Recession bar in 09, recession bar 91, and recession bar in 1982. In 82, Ronald Reagan had to raise interest rates, and then Canada fell in suit also with the recession, and so did and then that's when Mexico's currency went into hyperinflation mode and everything went nuts. And then after you had 91 is the other recession bar there, and then you had the big one of 08, 09, which were huge bailouts and bail-ins and all kinds of weird bailouts. Instead of letting companies forfeit, they let companies dwindle by the wayside, if you want to say it that way. So this is sourced from Bank of Canada here. There you go. That is 1.68 trillion. That's 1.6 million times 1 million. And these are your recession bars. Let's move on. There's two obvious trends contributing to high growth. But hold on, let's go back real quick here. But wages haven't kept up with inflation. So you got to go way back here on this bar to when wages were in line. So you got to go back to about 1972 to 74. That's when wages kept up with the price of inflation and the cost of goods. Then everything started to trickle, so wages would be here, look here, and wages would be like this. See my little arrow? That's what wages would be right now, right there. They're not keeping in line. Capitalism is great if wages keep up with inflation. Now, it's way up here, and people are still earning up here. Basically and that's another issue too, right? That's why people are paying so much for everything, because of lowering interest rates and devaluing the currency, of course. There are two obvious trends contributing to the high growth: the comparison period and data payment deferrals. The 6% year-over-year growth is the highest since July 2017, but it also compared to a year with very, very low growth. Last May was the slowest YOY, right, growth for the month since 2001. We covered YOY year-over-year growth on this channel from 2013 and 14 all the way up, and benchmark pricing here on this channel since then. As for deferrals, they topped 743,000. That's a lot of mortgages on hold. This month, at just 12 of the major lenders, this trend means at least 750,000 people aren't paying down their mortgage, just racking up interest. It's easy to see the debt pile grow if people aren't hacking away at it. More important is it means that very different thing in contrast to market-driven credit growth. Mortgage credit growth to continue into next month. Growth over the past few months has been soaring, almost making a vertical print. The annualized 3-month rate of growth reached 8.2% in May, the highest level since 2010. An annualized rate of growth is when a short period is projected as though it were through the whole year. So we talked about that again on the channel. When this number is higher, the year-over-year rate will almost always follow in that direction. If the number falls below the year-over-year rate, then it reverses direction. So far, the indicators in front of us show near-term growth. Here it is: Canadian outstanding mortgage credit change. The 12-month percentage change and 3-month annualized change of outstanding Canadian mortgage credits at a large institutional lender. So this is the 3-month right there. Holy crap. That's a big deal, man. Because look how crazy things were here back in the 80s, eh? Sorry, this is the early 90s, sorry. Then you saw the 92 right here. And you see how this silver lining is basically, wow. And then you see it back here in 07. And that's how you saw things weren't right. That's how you knew. That's how good economists could forecast that things aren't going good. There's some odd dynamics in the market that makes this a less than ideal trend for households. Sales volumes are down, even compared to last year's exceptionally weak numbers. This trend is also echoed in new construction, which further shows a softness for new loans. On the other hand, we know more households have stopped making payments, helping balances to rise. So this is a very interesting trend. There needs to be a reset. The problem is everybody was hit with FOMO back in 2015, 2016. A lot of people, I've spoken to people that have told me that they took a mortgage they bought in 2015. Okay? Now we're in 2020. They're 5 years into paying a mortgage. They're 5 years into paying it down with their down payment and everything. But they told me that they're exactly where they are when they started. If not, they're underwater now. And I'm like, okay, what happened? I tapped into my HELOC before this whole crap. I mean, I tapped into my HELOC 1 year after having my house. Making these high mortgage payments got boring, and I tapped into my HELOC thinking that my house was going to keep going up. So we're not even looking into the people that are not tapping into the ones that are tapping into their HELOCs and making their monthly payments aren't showing up in here because they're saying, let's hold back on deferrals for now because we could afford to make the payment with our second or reverse mortgage or whatever. So they just write a check from the reverse mortgage to pay their first mortgage, from their second mortgage to pay their first mortgage, right, on their reverse debt. So that is becoming a huge issue right now. Another major issue that's hitting a lot of households is unsecured debt. Debt that has basically no collateral that's taken on your signature. That you've signed your name basically saying for this credit card, this auto loan. And right now, we're not seeing the full front. They're not really talking about all auto loan defaults as much. They're not really on the fence with unsecured because companies write off the unsecured mortgages and people walk away or whatnot. And I'm not saying it's an easy thing to walk away from. Everybody is so focused on the mortgage lending sector, whether it's primary, secondary, tri lender, because of the economy that's so tied to housing. The economy is so binge drinking on housing. The GDP is so heavily in Australia, New Zealand, United Kingdom, Canada, Western United States, and New York, like Massachusetts and other little states up there, are so heavily binge drinking on in these inflated numbers, and then people leave, sell their home in California for $1.6 million, and then end up buying a house in Texas for 3 times the land and 3 times the house for like $240,000. So there's this huge unbalancedness in the United States, but there's still opportunity in the United States. Whereas in Canada and Australia and other parts of the Commonwealth, you're very limited to major cities. You're very limited to where you could go. Where you don't like Houston, you move to Dallas. You don't like Dallas, you move to San Antonio. You don't like San Antonio, you move to Austin. You don't like Austin, you move to, and that's all in Texas. You move to what's that other place in Texas? Texar or whatever county or whatever. You start moving around, right? But in Canada and Australia and the Commonwealth, you don't have much of a choice. And with FOMO kicking in, Canada got hit. Canada and Australia, the two hit the hardest. Australia hit very hard, but a lot of people moved to Hobart to make ends meet. And now Hobart's getting hit hard. So Canada, in Vancouver, everybody moved into the interior. I'm one of those statistics. A lot of people moved into the interior because they couldn't afford to live in the major cities. And it's not afford, but who wants to pay $2 million for a house? And the same house anywhere, let's say, in like 30 states in America, and in 30 different states, you could pick up that same house for like 1/10 of the price. Like literally 1/10 of the price. So, and we're getting hit with property tax. So that's something I kind of wanted to bring up too. Anyways, guys, share this video, get this out there. If you don't mind, guys, please subscribing to the channel. Only like 21% of the people that do watch my videos are subscribed. So if you guys want to subscribe and do me one, please do that. Subscribe, share this video. If you want to support this transmission, share this video. And here's the channel here. Go ahead and subscribe. Set your reminders for these shows coming up. And we'll go, lots of stuff to see. Come and be part of the channel. Come on our live streams and talk. Come call into the show. Tell us what's on your mind. Trends in the housing market this Wednesday. Don't forget. Thanks for watching, guys. And I'll see you guys soon, okay?